Mike Tedeschi, Wealth Management Advisor for Perspective Wealth Planning. With this week's market breakdown, we have a great video for you this week. We're going to take a look at the four major U.S. indexes. We're going to take a look at the emerging markets, commodities, the U.S. dollar, and we are going to take a look at the option speculative behavior that we have seen out of the retail side of the market here as of late. You're definitely going to want to stick around for that because it is fascinating. As always, if you like this content, please subscribe to our channel so you can see this information on a weekly basis. Let's jump into it. This year has been a record-setting year in a lot of ways, and we just set another record for the quickest pullback from all-time highs 3 days ever. The Nasdaq dropped almost 12% in 3 sessions. So we've had an incredible run-up, and we talked about this last week where we had an angle of attack of about 45 degrees, and then we went like this. All right, and usually when this happens, one of two things is going to happen. We're going to trade sideways in base, right, and kind of digest that move, or we get a pullback. And we got our pullback. Now, the interesting thing is, even though we had a very sharp pullback, all of the indexes have found support at the first level that you would expect them to. All right, if we look in here at the Nasdaq, you can see that 11,000 level is really an important zone. If we fell under that, then we'd be looking back for a move to about 1050, and then we've got that next one at about 9750, which was that breakout from new all-time highs earlier this year. The S&P 500 has found support right around that all-time high, nice round number of 3,400. It undershot it just a little bit, but immediately bounced back up. Right, next zone of support is about 3,200, and then under that about that 3,300 zone in on the S&P 500. Even the laggers, like the Russell, who has not made a new high, got rejected at that 1,600 zone that we were talking about, but it fell right to 1,500 and it made its first bounce. Now, the Dow didn't make new highs either, but found its first level of support right where one would expect it, that a breakout from about that 27,500 level. Now, the Dow is a bit concerning for me for a couple of reasons. We did not make a new high here, right? This actually looks like it could be a potential double top if we don't hold this zone. Okay, we came right up, couldn't make a new high, and then rolled over. We would end up with a lower high in place. If this were to fail and we started to head lower, that would be a big concern. But if this first zone of support holds on all of the indexes, right, even though we had a really, really sharp correction, maybe it was just because we kind of got ahead of ourselves and it was just the market kind of moving sideways or pulling back a little bit, so to speak, to undo that overbought condition, but not necessarily letting all of the air out of its sails. So what happens here at those zones I just laid out on these indexes is really, really important. Now, the emerging markets look a lot like the Dow in terms of this could be a potential double top if it were to fail here. So in the emerging markets, we talked about this 1100 to 1140 zone. It's failed there, and just like the Dow, we have a lower high and potentially turning lower. But also like the Dow, it has not broken its major support. If we fall underneath 1050 in the emerging markets, I would start to get concerned that this actually is a lower high, ugly kind of technical setup there. All right, we're going to look at the U.S. dollar when we start talking about the emerging markets as well. Let's see what's going on there. Now, one of the things, if you've watched a lot of these videos from me, is sometimes I'll draw these channel lines on the chart, but the most important thing for me really is the horizontal levels of support and resistance. The reason being, with diagonal lines, they get broken through time even if we just trade sideways. So they don't always necessarily mean something. You have to look at when something breaks, does it do it on volume, etc., to get a really good indication. So we did pop up above this channel. We fell back into it 2 days later, but really the important thing to watch on the U.S. dollar is that 94 zone. Okay, if it gets up over 94, then we might start talking about this 92 as being at least a short-term bottom. But it hasn't done that yet, so I'm still looking at the dollar from a bearish perspective. Target 91. If again we break over 94, then I think we go back up and test that 96. But this, as we've talked about a number of times in the past, has a big impact on commodities in general. Gold, when we take a look at it here, interesting action, right? It has just been trading sideways for a while. We talked about this as, what could happen there for the major indexes last week, where you had a sharp sell-off, then you kind of bounced back and you traded sideways for a while, working off this huge move that you had. We're watching gold over 2,000 and under 1,900, but so far just basing sideways and acting nice. Silver looks very similar. I think 29 is the level we're looking for over that for a close over 29, as it's kind of got that same type of pattern. And copper is holding over that $3 level that we've talked about here for a while. So if I back this chart up, you can see the importance of that $3 zone. So that's an important, again, potential economic indicator. Copper, is one of those materials that, as price goes up, usually shows that things are being built, etc. Again, this could just be from an inflationary standpoint, but it is interesting to see copper pushing up. However, what breaks that narrative a little bit is oil. Oil is always, a good indication of economic activity because a lot of the economy is actually built off of that energy space. And oil. So when we look at this chart, we talked about this big gap at 41.50 to about that $35 zone from earlier this year. We came back up into that zone, finally broke over 41, but we weren't able to go anywhere. If you look at this over the last 2 months, it's been very, very small, kind of non-volatile range until the last 4 sessions where we had a huge move down from about 43 to 36 in 3 days. And in fact, yesterday or 2 days ago, oil was actually down 8% at one point during the day. So it looks like some air is coming out of this. If it doesn't hold 35, then you're starting to talk about oil back into the 20s, which would certainly be a concern for the the idea of the economic recovery. So we're going to pay very close attention over there. Now, what I really want to talk about is sentiment data and retail option data. So let's pull that up. Now, the reason I like to look at sentiment data alongside a technical analysis is with technical analysis, we get some very good insight, right? And we can absolutely use a lot of different things from it. But what's missing is really that view of how many people are loaded up on which side of the ship. And sentiment data kind of gives us that example and gives us that understanding. And the reason why that's important is during the meat of a move, the masses are right. So during a big run up to the upside, the bulls, are making money all the way up. But at some point in time, there runs out of buyers, right? When everybody is bullish, there's nobody left to buy. When there's nobody left to buy, price can't continue to go higher. So we look at sentiment data to kind of see how many people are on each side of the ship, either bullish or bearish. And when we get really extremes, one way or the other, that oftentimes can show us potential turning points. Doesn't always work, but it gives us a good idea of what an area where something might turn around from based on what the masses are doing. And what we've got going on right now is just historic in terms of small option contract buyers. Retail option traders have put speculative bets on in a way that they've never done in history, and we have a couple of different charts to show that. When we take a look at small trader call buying, and this is option contracts of 10 or less, they make up 53% of the premium, highest that it has ever been in history. And we're going to look at this in a number of different ways. Next, let's take a look at this from the smallest traders have now become the largest speculators. Small option trading, less than 10 contracts at a time, make up 63% of the volume, which is much more than the large and the medium option contract traders at the moment. There have only been a couple times in history where we have flipped. We had that happen in 2000. We also had it happen in 2012. We're actually going to put these on a chart here in a moment. But we've never been this far out, right? 63%. So we've eclipsed both of these other highs, which is a concern. Next, we're going to take a look at for less than 50. So we're going to kind of increase that size. Call buying to open of less than 50 contracts, and this is in millions of contracts being open. You can see what's happened here in 2020. We have exploded in terms of the amount of money that's been put in on the options side. It's 3 times what it was last year. We've never seen anything like this in history. Tons and tons and tons of speculative behavior. If we look at this in another way, just from premiums spent, so you can see it from a dollar perspective, last week $16.5 billion got spent opening calls. That is unheard of. We've never had anything close to that before in history. So we are in absolutely uncharted territory when it comes to speculative behavior out of the retail traders. Now, here it is backed up and looked at it in another way with the S&P 500 on it. This is call buying to open minus put buying to open. So just the amount of money that's spent on bullish activity. Less than 50 contracts, and it is scaled in percentage of the S&P 500 market cap over the previous 4 weeks. We see a couple of spikes here on this chart. One is 2000, right before this happens. The other is 2007, right before this happens. And then once again, there's that 2012 that we talked about. That happens here. We do get a pullback, but we ultimately continue on higher. Again, here is where we are right now. We are way above in terms of the speculative behavior that's going on here than we've ever had before in history. And these, again, if we look at the amount of times that this particular thing has happened, we've had a pullback each time, 2 of them major. So the question being, is this like 2012 where we just saw that quick drop lower like we just saw here over the last week and we've continued to head our way higher? Or is this something a bit more ominous with the amount of money that's being pushed in on the speculative side? The question I pose is if this is how much capital is being spent from the retail traders in on call buying activity here, how much longer can this continue? How much more money is sitting on the sideline? How many more people are there left to drive this market higher? And that's the question. And we don't know because, again, we're in unprecedented times, not just from the sentiment here in the retail trading option speculation, but we've never pumped more money into the markets in such a short period of time ever in history. The Fed has put trillions of dollars into play this year, and interest rates are 0. So money has to find a way to make money. And so really the only game in town has been stocks. And that's why we continue to see money flow into the market. So does this mean tomorrow the market is going to crash? No. But this is certainly absolutely fascinating when we look at it against historical numbers. We've never seen speculation like this before in history. And usually when we see some sort of out of control data set like this, it usually doesn't necessarily end in the best way. So this is just another cautionary tale. This is not something to go out and just get rid of all of your stocks and hide under your mattress or anything like that. It's just be aware that we are in a period of time that is unprecedented, and we have a lot of money betting on the long side, a ton of speculative behavior, and it's something that we should be a bit concerned about at the moment. As always, guys, I hope you found this information useful. If you have any questions, comments, concerns, you want to talk to me about the overall market, please reach out, Tedeschi at perspectivewealthplanning.com, or you can reach me at 814-580-9881. As always, I will see you guys next week. Stay safe. Take care.